Hi everyone, and welcome to ACCA P4 live session. Last week we were looking at adjusted present value and capital asset pricing model. So this week we're picking it from chapter number 8, which is international investment appraisals, and then we go to chapter number 9, which is going to deal with valuation of business. So I'll go straight to international investment appraisal, chapter number 8. Okay, international investment appraisals. Some people will call it overseas investment. Okay, what is international investment appraisals? We've already learned investment appraisals in chapter number 2. And in chapter number 2, we emphasize that to appraise an investment, you need an investment appraisal techniques, which we saw NPV, internal rate of return, discounted payback period, duration, modified internal rate of return. Last week, we also saw adjusted present values. All of them are techniques for appraising investment. The investments that we've done so far, it's like we are based in one country and we are doing that project in that particular country, and that is called domestic investment appraisals. So whatever we have done so far relates to domestic investment appraisals, meaning you are in country A and you are doing the project in country what? A. International investment appraisals will come in when you are in country A and the project is going to be done in country B. That is when the international investment appraiser comes in. The examiner is not going to tell you this is an international investment appraisal, this is domestic investment appraisals. It is your responsibility to know it from the surface of the question. So if I go to the exam room, I have to appraise an investment. Nothing is said about the countries involved. Then my assumption straightforward is that it should be a domestic investment appraisals. However, if I go to the exam room and the question says I am based in country A and I'm going to do the project in country B, international investment appraiser is calling me. If I have to appraise investment, being it international or being it a domestic investment appraisals, I need certain things. We need the number of years, we need the relevant cash flows, and we need the appropriate discount factor. It cuts across whether domestic or international. The number of years is the same. Appropriate discount factor is the same as we've learned. It could be project specific work if I'm calculating NPV, or it could be cost of equity and geared if I'm calculating APV. That would depend on the method or the technique of the investment appraisals. What is different between international investment appraisals and domestic investment appraisals is basically how to generate the cash flows. Okay, is basically how to generate the cash flows. How will you generate the cash flows? Okay, how will you generate the cash flows if it is international investment appraisals? Picture what I am going to say. Okay, so now if for instance I am based in the UK and I'm going to do the project in Germany, this meets the definition of international investment appraisals. In that case, what should I do? First, because the project is being done in Germany, my sales, my variable cost, my specific fixed cost, my tax savings on capital allowances, my working capital, initial investment, residual value, all of them should be generated in Germany, and the German currency is the euro. So my sales and all the net cash flows will first be generated in the currency of the country in which the project is supposed to be undertaken. So when I get the net cash flows in Germany, then I would have to ask myself, my shareholders are not based in Germany. My shareholders are based in the UK. So if I'm appraising the project, I have to appraise it from the point of view of my shareholders because I want to maximize their wealth. So when I get the net cash flows in Germany, then I would have to bring the net cash flows back to UK. How will I bring the euro to UK? I have to convert the euros into UK currency, which is the pound. How will I get the exchange rate? The examiner might give me basis for me to calculate the exchange rate over the period concerned. And when I get the exchange rate, I use those exchange rate calculated over the period concerned to convert the euro into my pounds. When I bring it to UK taxman will also ask me, you have brought money into UK. Is this subject to UK tax? Then you need to ask, is there any double taxation agreement between the two countries involved? Okay, and then you sort the double taxation, you sort any other cash flow, then you come and get the net cash flows in your home currency, which in this example is the pound. And then what will I do? If it is MPV, I discount using project specific WACC. If it is APV, I discount using what? The cost of equity and geared, and I continue. So your cash flows first generate it in the currency of the country in which the project is supposed to be undertaken, and then convert it from that currency and bring it into your country. Sort out your double taxation, if any. Sort out any other cash flows. Get the overall net cash flows. Then ask the question, what technique do you want me to use? So what I have explained is what is given to you in your note. In order to appraise international investment, identify your relevant cash flows in the currency of the country in which the project is supposed to be undertaken. Then dealing with, whilst you are generating the cash flows, you have to deal with inflations and all that, which will bring nominal and real issues. Deal with tax and tax savings on capital allowance in the country in which the project is supposed to be undertaken. Also deal with intercompany transactions like management charges, royalties, and cash flows remittance restrictions, which we'll have a look at that. And then estimate the exchange rate. When you get the exchange rate, you convert everything to your home currency. And when you get the net cash flows that you have brought into your home currency, sort out your double taxation, sort out any other cash flows, and then you will calculate the appropriate discount factor, and then you get an MPV or APV, or you continue. So international investment appraisal, I don't see it to be difficult in terms of principle, but in terms of doing it, it consumes time, because it's like you are doing domestic investment appraisals in your host country, which example is Germany there, and when I finish, I also bring it into my country to come and do a continuation. So you are doing it twice, and normal domestic investment is a bit time consuming. So international, that you doing it twice, is more time consuming, and I always tell students that you have to speed up. The only good news about international investment appraisal is that anytime there's a question on international investment appraisals, students generally do well because they have the flow. So just get the flow, get the cash flows in the country in which the project is supposed to be undertaken. When you get the net cash flows, use the exchange rate to bring it into your country. Sort double taxation out, sort any other cash flows associated with the project in your country, and then calculate the cost of capital and continue with it. The question here is, do we do the project from the parent point of view or the project point of view? As we said, the argument is our shareholders are based in our country. They are not based in the country in which the project is supposed to be undertaken. So if I'm doing the project in Germany, my shareholders are not based in Germany. So I'm not going to look at from the point of view of the project. I have to look at from the point of view of my parent company. Where is the parent company? Because that is where majority of the shareholders are. So all what that chapter or heading is telling you is that calculate the MPV with respect, or appraise the project with respect to the currency of your parent company, not the project. So don't calculate it in terms of the euro, calculate it in terms of the MPV, because my company is based in the UK. So have a look at that. If you want this one, you can just cancel it because the calculation brings it out. All what we are explaining there is just to remind you that you need the net cash flows overall in terms of the currency of the parent company, not the currency of the country in which the project is supposed to be undertaken. Now, what the lecture note is trying to do here is that we are showing you all the techniques that we are not familiar with. We know how to generate sales and inflation, variable cost and inflation. We also know how to get specific fixed costs, tax and tax savings on capital allowance, working capital, residual value, initial investment. When we get the net cash flows in that country, then we have to estimate exchange rate. So we will show you how to forecast exchange rate. We will also show you if you determine the exchange rate and you bring the money into your country. We said sort out taxation. How are you going to sort it out? That is what we're going to explain. So international investment appraisals, your tax and your tax savings on capital allowance will follow the tax rules in the country in which the project is supposed to be undertaken. I'm doing the project in Germany. The asset is based in Germany. I have to get the capital allowance based on Germany rate. I have to pay tax on my taxable profit in Germany. Then based on Germany tax percentage. When I finish and I get the net cash flows and I'm bringing it back into UK, the moment the money gets into UK, the UK man will say, or tax man will say, you have to pay tax. There's a question of, is there double taxation agreement between the two countries involved? And double taxation principle is saying you have to pay the highest rate among the two rates. So example that we've given here is, we are based in UK. We are doing the project in Italy. Italy, the tax rate is 20%. UK, the tax rate is also 20%. So if I have already paid the 20% in Italy before I got the net cash flows and I brought the net cash flows into UK, the taxman in UK will say, oh, because there's double taxation agreement between the two countries and you have paid 20%, and you also have to pay 20% here, because you had already paid the 20% and there's that double taxation, you are not going to pay any extra. We are going to give you a relief of the 20% you pay. So in UK, you are going to pay no additional tax because the 20% which you have paid there is enough. It cancels. That is the essence of double taxation. You don't have to pay tax twice on the same profit. Okay, if in Italy the rate is 20% and in UK the rate is 30%, as I said, the principle is you will have to pay the highest world rate. And as such, if I pay 20% in that country, when I come to my UK and it's 30%, UK taxman will say, oh, because you've paid 20% and there's double taxation, you have to pay extra of only what? 10%. So the extra 10% is what you have to pay in the UK. The 20% had already been paid in that country. Then last one, 20% in Italy, but in UK is 18%. When you come to UK, because it's less than the Italy one and you've paid the 20%, here you don't pay any tax. The taxman will not also give you the 2% because the principle is you would have to pay the highest rate. So if I've paid the highest rate in Italy, when I come to my country and my country rate is the less rate, I don't pay anything. Okay, and then it cancels off. So the principle is you pay the highest rate. So if you have already paid the highest rate, when you come to your country, you don't pay anything. If the rate you pay there is the same as your country, you don't pay anything. If the rate you pay there is less than what your country rate is, then obviously you have to top up. And that is why there is 10%. Now, another challenge that student will be called upon to handle is forecasting exchange rate. When I get the net cash flows in the country in which the project is supposed to be undertaken and I have to bring it back to my country, what will I do? There is the need for me to actually exchange that currency. How will I exchange it? I need exchange rate. How do I determine the exchange rate over the period? We can use what is called the purchasing power parity or interest rate parity. Purchasing power parity will be used when the inflation rates are given. And then interest rate parity will be used when interest rates are given. So when you go to the exam room, examiner reserve the right not to give you the forecast exchange rate. It is your responsibility to calculate it. So the moment you need an exchange rate, you go to the question, you ask, where is the exchange rate? Question says, I haven't given you for the number of years concerned. Therefore, I'm expecting you to calculate it. Okay, how do you want me to calculate it? Do you want me to use the purchasing power parity or interest rate parity? And question will answer you, I have given you inflation rate. So the moment I see inflation rate, purchasing power parity is calling me. The moment I see interest rate between the two countries, interest rate parity is calling me. It's a formula business. The formula is the same. The only difference is one is using inflation and the other is using interest rate. And this is the formula. Even though they quote it this way, I normally see this one to be confusing some students. So this is how I quote it for students. This is how I quote it. For the purchasing power parity, which is called PPPT, we use inflation. We use inflation rate. And the interest rate parity theory, we use what? Interest rate. So when the interest rate of the two countries or inflation rate of the two countries are given, and then I would have to think about them, the formula is the same. The formula is the spot rate at the point T should be equals to the spot rate now multiplied by, I say, 1 plus inflation A divided by 1 plus inflation B. What do I mean by A and B? Okay, they will give you the two inflation rate for the respective countries. So you need to use to separate them. Which inflation of the country will come here and which country inflation will come here. It depends on the currency you are putting here. The currency you will put here, 8 countries inflation should be here. So if I put dollars here, the US inflation rate should be the inflation A. Okay, so if you look at the lecture note and even ACCA formula sheet, they quote it SO times 1 plus inflation foreign divided by inflation home. It is creating confusion. Where is home and where is foreign? So people think, oh, home is your parent company's country and foreign is the other country. And meanwhile, they've given you your home country's currency you are putting here. It changes the whole argument and that confuses a lot of students. So the simplest way you can do this is whatever currency you are putting here as the spot rate, 8 countries inflation should be up. And the inflation of the other country is going to be the down there. That's it. The same formula is for interest rate parity. Interest rate parity is used to calculate the forward rate. So my forward rate at the point T will be the spot rate now multiplied by 1 plus interest A divided by 1 plus interest B. And it is following the same argument. And that argument is that whatever currency I put here, its interest rate will be the one up there. And the subsequent one will be, or the interest of the other country will be the one as the denominator. So watch out. So now let's quickly go straight to the note, and then we pick this question to illustrate. So Start All PLC. Start All PLC wishes to estimate future exchange rate based upon the following projections of inflation. Year 1 to year 5, UK, USA, Begonia. Required if current spot rate are $1.6 to £1 and Begonia doll $2.50 to £1. Using the purchasing power parity theory, what are the predicted spot rate for the currencies concerned at the end of each of the next 5 years? This is the challenge in the exam room, because in the exam room and international investment appraisals, nobody is going to tell you this, that, oh, estimate using the purchasing power parity. It's implied in the question. I have to get exchange rate. I see that they've given me dollar exchange rate and pound exchange rate now. That is the spot rate I need for the next 5 years. What will I do? I go to the question. How do you want me to calculate it? They've given me UK and then US inflation rate. So giving me inflation rate, I don't need anybody to tell me, Fred, you have to use the purchasing power parity. They are all implied in the question. They are implied in the question. So having seen the inflation, it should tell me I have to use the purchasing power parity. And how do I calculate using the purchasing power parity? I go and put my formula down. Okay, so I will put this formula down. When I put this formula down, then I should be able to calculate the exchange rate. If you can do between two currencies, you can do between any other currencies. So I am going to illustrate by estimating the exchange rate between the pound and then what? The dollar for the next 5 years. If you have time, you can also do between the pound and the Bargonian doll, whichever. Okay, so if you can do one, you should be able to do for all. So I'm doing between the pound and the dollar. Okay, now currently the spot rate is given to me at 1.60 to the 1 pound. So I am going to say my spot, which is year 0, my spot rate is given to me as $1.60 to 1 pound. So dollar is what is given as the variable currency. So when I come to year 1, I'm going to say my year 1 rate will be $1.60. I am filling this formula. $1.60 multiplied by, I open that bracket. Because I have put dollar here, the US inflation should go up. US inflation in year 1 is 5%. So 1.05. UK inflation is also 5%. 1.05. This one will still be 1.6 dollars to the 1 pound. If you remember, purchasing power parity said a country with higher inflation, its currency is supposed to depreciate relative to a country with a lower inflation. So if the countries are having the same inflation rate, then of course the exchange rate will stay as it is in the name of purchasing power parity. Year 2, I bring the year 1 of 1.6 multiplied by year 2. US inflation is still 5%. UK inflation is still 5%. I will have 1.6 again. Year 3, I bring the year 2 figure of 1.6 multiplied by year 3. US is 7%. 1.07. UK is still 5%, and the figure is going to change. How much is it going to change for? And then that is going to give 1.63. Year 4, I will bring 1.63 multiplied by what is US inflation? According to the question, 7%, 1.05 for the UK, and that is giving 1.662. And then year 5, 1.662 multiplied by year 5 inflation rate. US is still 7%, UK is still 5%, and this is 1.693. So these are the exchange rate I will use over the period. These are the exchange rate I will use over the period. So when you get the net cash flows in US and you have to bring it to UK, it's your job to estimate the exchange rate and then convert it and bring it into your pound. So now let's go to the note quickly, and we pick the next one to illustrate. Project discount rate. I don't have to say anything about project discount rate because we've done cost of capital, and we said if I'm calculating NPV, then I will need project specific cost of capital, if you remember. Okay, so I will need to calculate the project specific cost of capital. If I'm doing APV, then I will need the cost of equity and geared, and then I will sort the finance effect cash flows. So when I get the net cash flows overall, my cost of capital should be the cost of capital consistent with the systematic risk. NPV says the systematic risk should be both business and financial risk. APV says no, we have to separate financing from what? Operations, and and therefore we need a cost of equity ungeared, and we continue to do the financing effect cash flows. So the examiner can ask you to use APV or NPV to do international investment appraisals, and you follow suit. The only difference is how to get the net cash flows. Generate first in the country in which the project is supposed to be undertaken, determine your exchange rate, bring it, sort your tax out. Okay, remission of funds. This is actually a repetition. It is also called overcoming the exchange controls, block remittances. If you see the point there, they are the same. Okay, the question that will come here, the examiner is going to ask, how can a company overcome block remittances? Okay, what do we mean by block remittances? Okay, we all said when you generate the cash flows in Germany that we're going to do the project, what should I do next? I would have to convert it and bring it into pounds. Okay, what is the implication? Exchange rate is generally determined by the movement of demand and supply of that particular currency. The more you supply a currency, the more the currency will depreciate relative to other currency involved. So the argument here is, if I do the project in Germany and I've got the euros and I want to convert the euro into pounds, I am going to supply the euro. When I supply the euro is expected to depreciate against my pound. Therefore, the German government will say that no, when I allow you to bring the money to your country every year, you are going to supply my currency, and my currency is going to depreciate. My exchange rate is going to worsen. Therefore, I am not allowing you to bring the money at the end of every year. That is why it's called block remittance. So the monies that you are bringing, that is what that country government is not allowing you. They are blocking that remittance you have to bring from that overseas country. So the examiner will ask you, how do companies go around it? How they go around it is this. They would have to create an artificial expense in that particular country. So what are we going to do? What we can do here is that we can say, oh, we are providing some managerial assistance to the subsidiary in Germany. So they have to pay us what? Managerial fees. Or what we want to do is we want to reduce the net cash flows in Germany. So to reduce the net cash flows that they will block, all what you need to do is to create an artificial expense for the German subsidiary. So as artificial expense you can create includes something like management charges. So they will see it as an expense, and then they will pay us indirectly. It will come to UK in the form of what? Income. So that the net cash flows in Germany will be less. Royalties, if there's a product that they are producing, we will say that, oh, whatever unit that they produce, they have to pay us royalties for using our right. That will also create an expense for them. We can also use what is called transfer pricing. If you look at the June 2015 exams, the examiner brought in royalties and transfer pricing as a way of reducing the expense in there. Even though he didn't ask you to write how to overcome, he used it as calculations. Okay, which example here will be illustrating that. So transfer pricing is if we have to send them a component or materials for them to use, instead of selling to them at £10, we're going to say we're going to sell to them to, let's say, £50, so that the more they pay, the more it becomes expense for them, and their cash flows there is going to be less, and then we will be able to get more money in our parent company. So this is how you have overcome block remittances. Simple common sense is create an artificial expense for them, and that will reduce their money, and you bring the money back indirectly to UK as an income. Most international investment appraisals, the examiner is going to ask you how or discuss other risks associated with that particular investment. If I've calculated the NPV is positive, or APV is positive, we will conclude that the project is financially what? Acceptable. But every investment appraisal international, the examiner will ask this question for you to talk about assumptions and other risk factors you have to consider. And this is book work. It's normally for 9 marks, 12 marks and all that. 15 marks. I encourage students to pick them straightforward. What other risk factors should you take into account? First one is exchange rate risk. We use the purchasing power parity to determine the exchange rate. Is it going to be the same as what we will see in the future? It is just an estimate. Once it's estimate, it's not likely to be the same. So we are exposing ourselves to that exchange rate risk as long as we have entered into foreign currency denominated transaction. The euros that we have to convert into pounds is subject to movement in exchange rate. So there's exchange rate risk in there. There's also political risk. Political risk is not only coup. There are so many links with political risk. It could be one of the questions, for instance, if even I have to pick the last sitting, which is the June 2015, the question stated that the government, the ruling government in that country is giving our company many concessions, and that ruling government is liked by the citizens in the city. The citizens of that country in the villages, they are not happy with the current government because the current government has brought austerity measures. Okay, and there should be election along the line. So if there's election along the line and that government that gave you that many concessions is not liked by the rural folks, and the rural people are many than the city people who like the government, they are going to likely vote against that particular government. The moment there is change of government, what is going to happen? The new government come in might not give you the same concessions as the previous one gave it to you, and your MPV that you calculated is going to be distorted. So you need to think about that. So what do I tell students? You don't waste time to cram these. Get them as headings: political risk, exchange rate risk. When you go to the room, you have to link it to the scenario in front of you. Here we've said expropriation of asset. Maybe the government is going to seize the asset. If it's not in the scenario and you go and talk about it, it's out of the question. Okay, blockage of what? Repatriation of profit is linked with block remittances. They are all part of political risk. If the government believes that it will have negative effect on their exchange rate, they will block it for you. So pick some of them and link it to the question. Anything associated with the government that might reduce the MPV is a political risk for you. Okay, think about also economic risk. Economic risk is in relation to government spending policy, recession, and trading conditions in that particular country. I am going to do this project in country A. The government is coming out with austerity measures. The government is not spending. Per capita income is very low. When I produce those goods and I'm selling in that country and people are not getting money because the government has reduced wages and all that, and people are not having money, how do you expect that your product will be bought? It's all economic risk. Physical risk is in association with tax and related capital allowances and all that. If the tax rate changes and all that, MPV will also change. Think about regulatory risk. All these that we are itemizing them here for you. Don't cram them. Link it to the question because these are general. ACCA questions are scenario based and you need to link it with the scenario in order to know or get the appropriate marks. If you give an answer general and it's not related to that scenario, you've just wasted time, ink, and paper. So relate them. Don't cram them. Pick some of them. Learn them generally and go and link it with the question in front of you. Regulatory risk is in terms of monopoly laws and all that. For all other things being equal, the law of the land will favor the companies or local companies than foreign companies, for all other things being equal. Okay, how do we finance overseas project? You can read that. It's all about equity capitals and debt capitals and all that. The only thing I'm going to explain is euro currency loan. When we say euro currency loan, it's not currency or loan that we are picking in euros as currency used in the Europe. No. Okay, when we say euro loan, euro currency, then what we meant is that you are raising money in a country in a currency other than the currency of the country in which you are raising the money. So if I'm based in the UK and I'm raising money by way of what? Dollars. If I go to UK bank and I raise loan in dollars, I will say I have gone in for euro dollar loan. So if I'm talking to you in UK and I say, oh, I've gone in for a loan, what will you expect? You will expect that I have gone in for a loan denominated in pounds. But when I tell you, oh, I have gone in for euro dollar loan from a UK bank, I'm telling you that I have taken a loan in dollars. But because the currency in UK is pounds, then I have to support with euro. So when you raise loan in a currency other than the currency of the country in which the loan is raised, we bring the word euro before that. So if I go to, let's say, Zimbabwe and I go and raise money in pounds, I will say I've raised euro pound loan, because Zimbabwe, their currency is not what? Pounds. If I go to India, their currency is the rupee. If I raise the money in terms of what? Dollars, it is going to be euro dollar loan. Okay, so that is the case. Have a look at that. Euro bonds. I'm issuing the bonds in the country to raise money in the currency other than the currency of the country in which that particular bond is actually issued. So if I go to US and I issue bonds and I'm getting what? Pounds. Those buying the bonds are paying pounds. I will call it euro bond. Same way, euro equity. I'm going to issue equity shares to raise money in the currency other than the currency of the country in which I am actually raising the money. So let's go straight. We take this question to sum up what international investment appraisal is concerned. When you get international investment appraisal question, it's a template you need to picture. First, you need to get a number of years the project is going to run. Second, you need to get the relevant net cash flows. The relevant net cash flows, you have to see it in two forms. First, generate the cash flows in the currency of the country in which the project is supposed to be undertaken. Then when you get the net cash flows there, you determine your exchange rate. You bring the money into your home country. When you bring it into your home country, is there any additional tax? You have to sort it out. If you finish that, then is there any other cash flows? You need to sort them out. When you finish, you get the overall net cash flows in your home currency. When you finish, you ask, am I using MPV? If I'm using MPV, I need the project specific WACC. Discount it, get the MPV. If the MPV is positive, you know how to conclude. If it's APV, cost of equity and yield, and then sort out what? The finance effect, as we saw last week. So we're going to use this question to illustrate. Most of the questions and international investment appraisals, the examiner is not going to tell you using MPV, using APV. They're going to ask you to appraise the investment and assess whether on financial grounds it's going to be viable for the company to undertake or not. And last week I told you, when they give you investment appraisal question, being it international or being it domestic, and the examiner don't give you the appropriate technique to use, it is your job to judge whether I have to use APV or I have to use MPV. I will use APV when I see subsidized loans, when I see issue costs. If I don't see issue costs, I don't see subsidized loans, then my normal MPV is okay. This is the challenge. Most of the time, the examiner had done the international investment appraisals and APV. Students are still calculating MPV. The moment you see subsidized loans, the moment you see what issue costs, the examiner is heading you towards appraising using APV. So when they tell me to appraise it, I hold on. I have to go to the question before I'll be able to judge whether I have to use NPV or I have to use the APV. So when we come here, said evaluate the proposed investment from the viewpoint of Brockday PLC. State clearly any assumptions that you make. What further information and analysis might be useful in the evaluation of this project? Question didn't tell us whether we have to use APV or we have to use what? MPV. When I go to the question, I'll be taken care of. Am I going to see issue costs? Am I going to see subsidized loans? If I don't see them, then I will evaluate it normal using my normal MPV. That is it. But if I see subsidized loans and issue costs, then I have to think of using what? APV. Okay, so now let's go to the question. I read. As I keep telling you, international investment appraiser questions are big. And anytime the examiner tests international investment appraisal, is question number 1. It is a 50-marker question because it is always big. So you can't read it like a storybook. You would have to indicate. Okay? Every paragraph you read, indicate what you picked in that particular paragraph. So I read. Brockday PLC is considering whether to establish a subsidiary in USA. Okay, the premises of the question is that the company is based in the UK and they are going to open the subsidiary in US. And that should tell you that because we are in one country and we're going to do the project in another country, this meets the definition of international investment appraisals, because nobody will be telling you this is domestic, this is international. No, it's your job to get it from the surface of the question. So if I'm based in the UK and I'm going to do the project in US, this is what is called international investment appraisals. So let's go on. The subsidiary will cost a total of 20 million, including 4 million for working capital. So this is my initial investment and working capital. A suitable existing factory and machinery have been located and production could commence quickly. A payment of 19 million will be required immediately, which with the remainder required at the end of year 1. So the 20 million capital I need, this is how it's going to be paid. Remember, we are dealing with cash flows. Most of the questions we see, initial investment 20 million, we are putting it in year 0 because they don't tell us when we are paying it. The assumption is that it will be paid now. We are dealing with cash flows and we are concerned with receipts and payment. Therefore, that 20 million total capital, which is made up of 4 million working capital, we're not paying everything in year 0. We're paying 19 in year 0 and the remainder will be paid in what? Year 1. Watch out. So this is the payment of that. Production and sales are forecast at 50,000 units in the first year and 100,000 units per year thereafter. These are units. Okay, unit price, variable cost, and total fixed cost in year 1 are expected to be at 100, 40, and 1 million respectively. So this is my selling price, variable cost, and then fixed cost. After year 1, prices and costs are expected to rise at the same rate as the previous year's level of inflation in the USA. This is forecast to be 5% per year for the next 5 years. So this is where I can also get inflation. In addition, a fixed royalty of £5 per unit will be payable to the parent company. Payment to be made at the end of each year. So I also see royalties here. Okay, Brockday has a 4-year planning horizon and estimate that the realizable value of the fixed asset in 4 years' time will be 20 million. What do I see? Planning horizon 4 years, so number of years, and then this is the residual value. It is the company policy to remit the maximum funds possible to the parent company at the end of each year. Assume that there are no legal complications to prevent this. What is it telling me? We will remit everything back into the parent company. So no block remittance. Okay? Don't read the question as a storybook. Brockday currently export to the USA, yielding an after-tax net cash flow of 100,000. No production will be exported to the USA if the subsidiary is established. That 100 we were exporting to US. So if we are going to establish the subsidiary, we cannot actually export there. It is heading me towards something like an opportunity cost. But listen to this. It is expected that new export market of similar wealth in Southern Europe could replace export to the US. So that 100, I can now divert it into Southern Europe. So whether I do the US project or not, that 100,000 will still be received. If I don't do the US project, I will export the 100,000 to US. If I do the US project, now I will export it to the Southern Europe. So there's no opportunity cost. There's no any benefit. I'm losing. I'm not going to lose that 100. So this is not an opportunity cost. I will leave it. It's irrelevant. So this is not opportunity cost. Simply irrelevant. I don't need to bother myself with it. Okay. United Kingdom production is at full capacity and there are no plans for further expansion in capacity. Tax on the company's profit is at the rate of 50% in both countries, payable 1 year in arrears. A double taxation treaty exists between the UK and the USA, and no double tax is expected to arise. No withholding tax is levied on the royalty payable from the USA to the UK. So this is tax information. Tax allowable depreciation is at the rate of 25% on straight line basis on all fixed assets. So this is my capital allowance. Brogdale believes that the appropriate beta for this investment is 1.2. The after-tax market rate of return is 12% and the risk-free rate of interest is 7%. So I will say market return, risk-free, and then what? Beta. That is the paragraph. The current spot exchange rate is $1.3 to £1, and the pound is expected to fall in value by approximately 5% per year relative to the US dollar. This is the exchange rate. Okay, this is the exchange rate. You have to use your own abbreviations and you flow with it. Okay, so what am I supposed to think of next? I have to evaluate the project from the viewpoint of the Brogdale company. What should I think of doing? What should I think of doing? Should I use APV or should I use MPV? I don't see any subsidized loans issue cost, so my normal MPV should be okay. So I go and open my sheet. I leave space there and I'm going to say yes. The project is for 4 years. 0, 1, 2, 3. Let me do my board well. 0, 1, 2, 3, and 4. I leave space in case something should go to year 5. Because I am doing international investment appraisals and the project is being done in the US, I first have to generate the cash flows on the basis of the dollars. So I will say dollars. I'm keeping everything in 3 zeros up, in thousands here. So first generate it in the currency of the country in which the project is supposed to be undertaken. This project is done in US, so first generate it in dollars. Then how will you start? I need to start with my sales. How do I get sales? Sales is selling price multiplied by unit. I leave a very big space. I go to the next page and then I am going to talk about my workings. So I come and do my workings. Whatever figures I will get, then I go there straight. So it's like you doing your domestic investment appraisals in US and bringing it back to UK to also come and do domestic investment appraisals in UK. So I'll say sales. I have year 1, year 2, year 3, year 4. What is the selling price? According to the question, our selling price, okay, I picked it from this paragraph. That paragraph is telling me selling price, variable cost. I go there straight because when I look on the sheet, I know what paragraph I can pick that. That's why I've told you some time back, I am not interested in you highlighting, because when you highlight, it doesn't tell you what is there. Look at what I've done. If I need unit, the moment I look on the sheet, I know this is the paragraph I have to come and pick unit. The moment I look on the sheet, I know where to pick selling price, variable cost, fixed cost, royalties, block remittance, tax, whatever, because I've indicated them. You go to that paragraph, you read, you move on. You haven't got the time to be reading and reading and reading and reading. It doesn't help. So selling price, I come and refresh myself. It said the unit price, unit variable cost, and total fixed cost in year one are expected to be 100. So year one, the selling price is expected to be 100, and they told us that it's going to increase by 5%. So what will be my calculation? Selling price in year one is 100 and is subject to inflation of 5%. So 100 times 1.05, that is giving me 105 times 1.05 is 110.25 times 1.05, 115.76, isn't it? 115.76. Then I will need my units. How many are the units for each year? According to question, I come to that paragraph straight. Year one, the unit is 50,000 and 100,000 per year thereafter. So I come here. My year one unit, you are 50. Year two is 100. Thereafter, my sales is God. This time that is going to give me, is it 5,000? This and that is 10,500. This and that is 11,025. This is 11576. My sales is done. I move myself up straight. What are my sales figures? This is 5,000. This is 10,500. This is 11025. 11576. I am done with my sales. I go to my variable cost. I go and do the workings and I bring myself up. Workings 2, variable cost year 1, 2, 3, and then 4. And I'm going to say variable cost per unit. I go to the question, what is the variable cost per unit? I come to that paragraph. Variable cost per unit is said to be 40, which is also subject to inflation of 5%. Okay, so you know where to pick what. You pick them and you are moving because you haven't got the time to hesitate. This is going to be 40. 40 times 1.05 is 42 times 1.05 is 44.1, and then times that again 46.31, and I've got my unit, which is 50, 100, 100, and 100. So I multiply. This is 2,000. This is 4,200. This is 4,400. Okay, 4410 rather, and then this one will be 4631. Okay, that is God. I move myself up. What are the figures? Variable cost is a cash outflow. So this is 2,000 and this is 4200. This is 4410 and this is 4631. Then I ask, I need specific fixed costs. Once it's international investment appraisals and I'm going to that country for the first time, any fixed cost I will incur there is an additional fixed cost. So automatically that fixed cost in that country becomes an additional and it's relevant. So I go to the question, where is the fixed cost? That same paragraph. Fixed cost in year one, they said is 1 million. That is also subject to inflation of 5%. I wouldn't do workings on it at all. Year one is 1 million, 3 zeros up. So that is 1,000 and it's increasing by 5%. So I'll say 1,000 times 1.05, which is 10 what? 50. Then times 1.05, which is 1103. And then times that 1,158 minus. Then I ask, is there any other cost the subsidiary in US is supposed to incur? That same paragraph, I saw royalties. So they have to pay us royalties. So to them, it is an expense. To the parent, it is what? An income. So that royalty, they said, in addition, a fixed royalty of £5 per unit will be payable to the parent company. Payment to be made at the end of each year. So I have to go and sort the royalty out. It's an expense to them. So royalties, I go down there and I do my workings 3, which is going to be on royalties, which is year 1, year 2, year 3, year 4. Okay, and then I will say, what is the royalty per unit. According to the question, they said it's £5 per unit every year. It's not subject to inflation. What will be the unit? We have 50, 100, 100, and 100. You have to be flowing. You have to be flowing. So this multiplied by that will be 250, 500, 500, 500. Look, this is in terms of the pound. So if it is in terms of the pound, what will I do? I need to generate the cash flows in that country in dollars. Therefore, this is supposed to be converted from pound to what? Dollars. So to do that, I will need exchange rate. So have I been given the exchange rate for the next 4 years? I'm going to ask the question. When I go to the question, where did I indicate exchange rate? I indicated it down here. And they said the current spot rate, which is year 0 alone. It means they haven't given me year 1 to year 4. So what is the examiner expecting? Examiner is expecting me to what? Calculate it myself. Okay. Is it purchasing power parity theory or interest rate parity theory when interest rates are given or inflation rates are given? Sometimes the examiner will push you that to that extent. Sometimes in order for him to balance time, he will make life easy. Okay, so here, what is the way he's expecting us to calculate the exchange rate? Question is saying the current spot exchange rate is $1.3 to £1. And the pound is expected to fall in value by approximately 5% per year relative to the US dollar. What is it telling us? The pound is expected to fall in value. It means the dollar is expected to appreciate in value. And in currency world, when a currency is appreciating, you will rather need less of it for the same amount of the other one. So if the dollar is appreciating because the pound is depreciating, then the dollar, I will need less dollars for the same amount of the pound. It's opposite to our normal day to day. If it's appreciating, you are rather lessening. If it is depreciating, you are rather adding more. That is how the currency world is. Therefore, if the pound is falling or depreciating by 5%, it means the dollar is appreciating by 5%. And as such, the dollar appreciating by 5% means I will need less of the 5%. And as such, I will need 95% of it. So you less the 5% from the 100. If the question has said the dollar is depreciating, you will add. So depreciating, add it. Appreciating, rather, you would have to deduct. It's opposite to the normal day to day. So I need to pause here because to complete this working, this is the principle of international investment. Appraisals, you have to be very organized. To finish these royalties, I will need exchange rate here. Exchange rates are not given. I have to go and calculate it. So what will I do? I need to pause here, go down there to workings 4 and go and do my exchange rate. When I finish, I come back and come and complete the royalties. Got the royalties, go up there to go and complete my table for the calculation of the net cash flows. So you have to be very, very organized. That is why you can't be reading the question over and over. Time will not allow you to do that. So I will say here that I need my exchange rate. Year 0, they've given me the spot rate. And the spot rate they said is $1.3. And year 1, what are we going to have? The dollar is appreciating by 5%. So 5% from 100 will be 95% multiplied by the 1.30. And how much are you going to get? I will get 1.235. Then year 2, that will also appreciate by that. So 35 multiplied by 95, you get 1.173. And then year 3, 1.173 multiplied by 95%. And that will give you 1.115. And then year 4, 1.115 multiplied by 95%. And that is given 1.059. For the sake in case something should go to year 5, and then that will be multiplied by 95%. So 1.095 times 0.95, and that is giving 1.006. So these are the exchange rate. Having got the exchange rate, now I can get the figures to convert the pounds into dollars that they would have to pay. So the exchange rate in year one, we said, is 1.235 as we have calculated here. So these figures are what I'm picking. Year 2 is 1.173. This is 1.115 and then 1.059. And this will be converted into dollar. Okay, because the dollar is more, I need to multiply. So 250 times this will give us 309. Next one is 587. This is 558, and then 530. So these are the dollar equivalent with respect to what? The royalties. Then I go up. Okay, what are the royalty figures? When we calculated, we got 0.309, we got 587, we got 558, and then we got what? Is it 530? And then I asked the question again, is there any cost again associated with the US? Nothing is there. We've sorted the fixed selling price, variable cost, fixed cost, the royalty. The rest is number of years, residual value, and all that. I don't see any cost again. So if I don't see any cost again, I can sum this up, okay, to get what we refer to as our cash profit. When I sum these figures, it's 1691 here, 4663, 4954, and then 5257. Okay, now be with me. When we did domestic investment appraisals, we got the cash profit here, and we did tax and tax savings on capital allowance. If it is international investment appraisals, I don't recommend that. For a reason I'm going to show. Don't copy this. Assuming my cash profit is 1,000, my capital allowance is, let's say, 1,200, and tax rate is 30%. Also, tax on cash profit is 30%, which is 300 I will pay, and tax savings on the capital allowance is 30%. 1,200 times 0.3 will give me, is it 360? So what have I done? I will say, I will save 360 and pay what? 300. In effect, I am saving extra what? 60. If it is a domestic investment appraisals, this is absolutely perfect. Why is it perfect? Because the assumption here is that we are assuming the company is having other project, and other project will give you a profit. Okay, technically this project is not giving me a profit. Remember, tax is a percentage based on taxable profit, and your taxable profit is the difference between the cash profit and capital allowance. So here I would have made a taxable loss of 200. That 200 taxable loss, when you multiply by the tax rate of the 30%, that is what is giving you the tax savings of the 60. So when it is domestic investment, we don't pay tax on project by project. Tax is paid on the company's whole taxable profit. So assumption is, if it's domestic investment, this project is making a loss of 200. This loss will be set off against other projects we are doing, their profit. So our overall taxable profit will reduce by 200. So this is perfect. But if it is international investment appraisals, we are going to that country for the first time. So if I'm going there for the first time, I haven't got any other project there. So when I make this loss of 200, it won't save me this 60, because no taxman will give you this 60 for you making a loss. The best they can do for you is you have to carry forward that loss. So for the sake of international investment appraisals, I don't recommend tax and tax savings on capital allowance? No, because when the examiner hide loss and you have done the tax and tax savings, you would have said, oh, the tax man is giving you 60 pounds or $60 for making a loss. Otherwise, every company will make a loss in order to get money from the tax man. It doesn't work like that. Domestic investment, the assumption is that we've got other projects that we will set off this cash flows or this loss against it. International, there is no any other word project which the loss will be set against. The best they can do for you is for you to carry it forward. How many years you can carry it forward, I can't stand here and say it. You have to follow the instruction in the question. If the question don't state anything, the assumption is that you're going to carry forward until the loss is fully utilized. So what do I advise? An international investment appraisals, when you get your cash profit, go out and go and calculate your tax as a figure, and that tax should be the cash profit minus the capital allowance, and that will give you the taxable profit. If you should get a taxable loss, carry it forward until the loss is fully exhausted, unless the examiner says something otherwise. Okay, so that is that. So international investment appraisers, please make sure you don't do tax and tax savings. Otherwise, when the examiner is hiding the loss, you will fall into that trap. So when I get here, I am going to pause and write tax as a figure. And that tax will be based on the taxable profit, which is the tax minus the capital allowance. Some solutions, like the one they did in your lecture note, they will bring the less capital allowance and get the taxable profit here, get the tax and add back the capital allowance. That is also a good approach, but I don't normally recommend that one for my student in exam room. Why? It's because of what I see through marking. What some students do is, when they less the capital allowance and get the taxable profit and they get the tax, they are supposed to add back the capital allowance. Whether it's pressure or lack of knowledge, they don't add back the capital allowance. If you don't add back the capital allowance, it has got a serious implications. The implication here is that you are telling the examiner that capital allowance is a cash item. That's why you are deducting it. Okay, but capital allowance, as we know, does not involve movement of cash. Therefore, I don't recommend that approach. I want you to get out, go and get your tax as a figure, come and put it here. So follow what I'm doing here straight. So I will go down there and I'll say workings 5, tax. My tax, I will need years. Year 1, year 2, year 3. This project is for 4 years. Then I'll say, what is my cash profit? Let's go and bring those figures. Year 1, our cash profit is 1691, and then year 2 is 4663, and then 4954, and then 5257. These are the cash profit for the respective years. To get the taxable profit, I will have to less my capital allowance. So I go to the question. How do you want me to calculate the capital allowance? Let's go to the question. Question is saying, where did we indicate capital allowance? This is the paragraph. It said, tax allowable depreciation is at the rate of 25% on a straight line basis on all fixed asset. Okay, on all fixed asset. So I need the value of the fixed asset, and the fixed asset will be got from the initial investment. When I come here to paragraph 1, I indicated initial investment. You see the massive coordination of information the examiner is expecting you to be doing. So if you don't indicate and you just highlight them, that coordination, simply forget about it. You can't. Simply, you can. And the question will be very, very lengthy because the examiner is going to scatter them. It's your job to indicate, to coordinate them. So whatever you need, you know the paragraph straight to go and pick. So when I come to paragraph 1, I see 20 million as the capital, for which the examiner said 4 million is for working capital. So if 4 million, our capital employed, don't forget, is total asset minus working capital, minus current liabilities. And total asset is your non-current asset plus what? Current asset. And we know current asset minus what? Current liabilities is the working capital. So total capital employed is my fixed capital plus the working capital. Therefore, if I have employed 20 million and 4 million is for working capital, then my non-current asset, which is the same as the fixed asset, is 20 million, isn't it? I mean, minus the 4 million. So my fixed asset will be the 20 million minus the 4 million, and as such is going to be 16 million. And that 16 million is subject to straight line depreciation of 25% or capital allowance of 25%. So I come here and I will say this is 16 million, okay, which is 16,000 at 25%. It's not reducing balance, it's straight line. So if it is straight line, every year it should be the same. 25% of 16 will give me, is it 4,000 every year? So this will give me 4,000 every year. If every year I've got 4,000, then what will be my taxable profit? What is the taxable profit? My taxable profit is the difference between this and that. And how much am I going to get? 1691 minus 4,000 is giving me a loss of 2309. And the difference here is 663. Difference here is 954. And difference here is 125.7. Now I need to pay tax. What tax should I pay? This is happening in US. So I need US tax rate. I go to the question. Where is the US tax rate? This is the paragraph. I indicated the tax. I come straight to that particular paragraph. Tax on the company's profit is at the rate of 50% in both world countries. Payable 1 year in arrears. Brilliant. So it means tax in the US is 50%. Okay, I come here. I have to pay tax of 50% in the US. But in the first year, I made a loss. If I have made a loss, I can't get any tax savings. Okay. If it is reducing balance, then it should be the 25%, and then we have to think about the 75% rule, isn't it? If it is reducing balance, I would have said 16,000 multiplied by 25%, which is what? 4,000. The second year will be 16,000 minus 4,000, which is 12,000 multiplied by 25%. You apply it on the reducing amount, isn't it? You apply it on the reducing amount. Next question is, there is a comment of 90 million in year one. And yes, there's a comment of 90 million in year one, and then year what? 0 and year one. It hasn't got anything to do with the capital allowance. The cost of the asset is 16 million. But how you will pay it, the cash flow implication is the 90 million will be in year 0, and then the 1 million will be in year 1. It's got nothing to do with the cost of the asset. The cost of the asset is simply the 60 million, and that is what you have to spread. Okay, so that is the difference. Good questions though. Right, so we're going to say that. Right, so we're going to say that 50%, what should we do? That 50%, we need to apply it on the taxable profit. But the 2309 is a loss. And this is a first time we are doing a project in that country. So what should we do? The best we can do is to carry forward. It won't save me tax. Therefore, year 1, I will pay no tax. Year 2, I carried 2309. This question didn't tell me how far I should carry it forward. So I will carry it forward until that whole 2309 is exhausted. So if I go to year 2, the 2309 is more than that. So here too, I will pay nothing. So 2309 minus 663 It's left with 1646 minus what? 954. It's still left with something. So this is 0. It's left with 692. Then when I come to year 4, it's 1257. So when I take 1257 minus the 692 left, I will be left with 586. This 586 is what I have to pay the tax of 50% on. So I will multiply by the 50% times 0.5 is given 283. So these are the tax payment. That is the reason why I encourage you, get out of that sheet. Come here, come and calculate your tax as a figure. Because if you have done tax and tax savings on capital allowance, you would have applied 50% on this and 50% of that. And you will say you are saving tax. And that doesn't happen. And you will be in a different world. This is what the examiner answer will be. Okay. Okay, is it not 565? Okay, let's have a look at it again. 2309 minus 663 minus 954, that is given 692 from 1257 is giving me 1 minute. Is it 565 multiplied by 0.5? Okay, so that is 283. Brilliant. That is 283. So having got the 283 tax, when I come to the cash flow, that is where I would have to be concerned about the cash flow movement. It should be done on the basis of receipt and payment. So when is the tax supposed to be paid? When I come to this cash flow, that is when I need it. The tax is supposed to be paid 1 year in arrears. So the figure of 283 in year 4 will be paid in year 5. So I come here 283 minus. This has taken care of both tax and tax savings on capital allowance. As long as I'm done with it, then I need my investment, which is my initial investment, residual value, and working capital, if any. The initial investment of the 20 million, 4 million is working capital, and then 16 million is fixed capital. That 20 million, we are not paying anything in or everything in year 0. According to the question, we are paying 19 million in year 0 and the remainder in year 1. This is the time I will need it because I've come to the cash flow and I need when the monies are being moving. So year 0, I will pay 19,000, and year 1, I will pay what? The 1,000. So this is the initial investment and working capital. Now be with me. So that 20 million, 4 million is on working capital. And what did we say about working capital? We all remember that working capital we put in should be recouped at the end of the period. So that 4 million within this 20 million, I have to get it back. And then recouping it of the 4 million, I have to get it at the end of year 4. When this question was originally said, most students forgot about the 4 million working capital recoupment. Okay, that is why I keep telling you, lead yourself through the principle. Lead yourself through the principle, because when you put in the working capital, something should click through the principle. You need to recover. And to recover it, how much is it supposed to be recovered? They said the working capital is 4 million. The whole of that 4 million is supposed to be recovered. Then what is the residual value? We go to the question, where did we indicate residual value? We indicated the residual value here. And they said they will sell it for 20 million at the end of the 4th year. So I will say residual value is going to be 20 million. And this is dash. Now be with me. This is another point many students forget. When you go to the exam room and the examiner wants straight line method, you have to be very careful. It is very straightforward, but the problem with it is you might forget about the balancing charge or balancing allowance. when we did the 25% reducing balance, if you remember the shortcut, we built in the balancing charge or balancing allowance, which is the loss or profit on the sale of the asset. So now let's apply. Let's come here. We had an asset with a total cost of 16,000. And that asset is fully capital allowance. Every year, we charge capital allowance of what? 4,000. So for the 4 years, the total capital allowance is also 16,000. So what is the tax written down value of that asset? In the taxman's books, the value of the asset is 0. But come the end of the period, you sold it for a residual value of what? 20,000. Therefore, you have made a profit in the tax books, which is called balancing charge. And that balancing charge is the 20,000. So if you have made a profit on the sale of 20,000, what do you think the taxman is going to do? The taxman is going to tax you, and the US tax rate is 50%. So 50% of that is equal to 10,000. And this will be sold at the end of the 4th year. So when I make the profit at the end of the 4th year, tax is paid 1 year in arrears. So I will say that tax on the profit of the sale will happen in year 5. So I will say tax on balancing charge is the profit on the sale of the asset, and that one is going 10,000 minus. And this is all. I've done my working capital, I've done my residual value, I've done my initial investment, tax and tax savings on there. Yes, this is in line with straight line method, Maria. It's not only for international investment appraisal, it's everywhere. Every time you use the straight line method, you need to remember to check the balancing allowance or balancing charge. It can be domestic investment or it can be international investment. Okay, so this is just like you doing your domestic investment, okay, in US. So if I've got these net cash flows, let's sum them up. This is 19,000. If you sum this, is 691. The other one is 4663, 4954, and then I'm having 29257, and the last one is 10283 minus. Okay, I have got the net cash flows in US. What should I do? I am not having shareholders in US. My shareholders are based in the UK. So these monies are supposed to be brought to the owners. So what should I do? I have to convert these dollars into what? Pounds. So I need my exchange rate. Technically, this cash flows, some call it remittable. Remittable cash flows. They are meant to be remittable to the shareholders of the parent company, which are based in the parent country. So now let's go straight here and we have a look at it. So we're going to say we have to go and determine the exchange rate. But so far as this question is concerned, we have already determined the exchange rate. Go and copy. If you haven't calculated the exchange rate, this is the time the calculation will call you to go and do it. But because we've done it, let's copy straight forward. So I will say the exchange rate I have got in year 0, which is the spot rate of 1.3. We got 1235, 1173, 1.115, 1.059, and 1.006. And then I am going to exchange it. The moment I exchange it, I have taken it from dollars to what? Pounds. So the sign should now change. The sign should now change. Okay, and this is what is called remitted. Now we have remitted it back into our country. So how much are we going to get? Because the pound is less, we need to divide. If you divide the 19,000 by 1.3, you're going to get 14615 minus. This is 560. This is 3975. This is 4443. This is 27627. And this is 10222 minus. Okay, now we have moved from the US and now we are in our country, UK. The moment I have brought this money into UK, the UK taxman will say, hello, you have brought this money, so you should be thinking of paying tax, unless there is double taxation agreement between my country and the country you are bringing the money from. Okay, so you have to ask the question, is there any additional tax to be paid? If there's additional tax to be paid, this is where it should be. Additional tax to be paid. So go to the question. What is UK tax rate? The question told us here, both countries are paying tax at the rate of what? 50%. And double taxation treaty exists between UK and the USA. So what is going to happen? If it is 50% paid in US and 50% paid in the supposed to be paid in UK, as long as the rates are the same, I don't pay any additional tax. But for the purpose of learning, I'm taking you to a next step in case it is not straightforward like this. Okay, as we saw earlier. So when we come here, this is where you would have to think of the additional tax. So I am creating a scenario. Assuming the UK tax rate was 60%. I'm deviating slightly from the question for the purpose of knowledge, in case you go there and the question is not straightforward like that. So assuming the UK, the rate is 60%. I have paid 50% in US, so I need to pay additional what? 10%. So that additional 10% I need to pay. What should I apply the 10% on? This, be with me. This is the second reason why I want you to come out and come and do the tax. Okay. We don't apply tax as a percentage on cash flows. We apply it on the taxable profit. So when we come here, this is the mistake most students do. Because they've got this remittable cash flows and US is 50%, UK is 60%, they apply the 10% on these figures. It is not accounting. It is not tax. Tax is not paid on cash flows. Tax is paid on taxable profit. And what was the taxable profit we got on the project? The taxable profit we got on the project is what we have calculated here. And remember, this taxable profit is in dollars. So the 10% will be based on this taxable profit. Here will be 0, 0, 0. And here we saw 565. And we apply the 50%. It is left with extra 10%. 10% of this will give me 56.5. And remember, this one will be in dollars. But we need the tax to be paid in what? Pounds. Therefore, I have to bring exchange rate. And when I bring the exchange rate, and then I will get it in terms of what? The pounds. And that is what I will put there as my taxable additional tax. Okay, so watch out. But this one, this bit is not part of it, because in the two countries, tax rates are the same. And once there's double taxation, once I've paid 50% there, I don't have to pay anything in this country. So I will skip. So for the purpose of learning, this is where your additional tax would have been. But this question is not applicable, so I leave it. Then I ask, is there any other cash flow associated with this project? The question said yes. The question says yes. There is additional what? Cash flows associated with this project. Don't forget, the examiner will not tell you again. We remember that we asked the subsidiary to pay us royalty. So to them, the royalty is an expense. To us, the royalty is an income. So we are going through the back door. We creating the expense there in order to generate what? Income in our country. So I will say royalties. Okay. And the royalties, how much pounds did we get? We did the calculation. Let's come to royalties. The pound equivalent of the royalty is what we calculated here. Year 1, 250, 500, 500, and 500. So I am going to get here, 1 minute. I go up here. My royalties in pounds will be 250 for the first year, and then 500, 500, 500 for the remaining 3 years. And then don't forget this royalty, it was expense in the US. It saved them tax. So you, UK branch, you haven't paid any tax in US. It saved you tax rather there. You haven't paid any tax. So the UK man will tell you double taxation doesn't affect this because it saved you tax. You didn't pay tax on it in US. So the 250, the 500 that you brought in the UK, it is subject to full UK tax because you haven't paid any tax on it in the US. Rather, it saved you tax. Therefore, if you have brought the money here, then you have to pay this whole tax in the UK. So you say tax on royalties. Okay, and tax is paid 1 year in arrears. UK rate is what? 50%. So 50% of this is 125 minus, this is 250 minus, this is 250 minus, and then 250 minus. And then we have to sum them up. There was something like an opportunity cost. We concluded there is no opportunity cost because we can sell it in Southern Europe. So there's no any other cash flow. Sum them up and this will give you the overall net cash flow. So this is going to give you 14615 minus. This is what we will say net cash flows. And this one is 810. This is 4350. 4693 27877 10472 minus. When I get this overall net cash flow, this is the difference between domestic and then international investment. That's it. Domestic, we would have ended here. That's all. But international, we have to bring it and continue to get the cash flows in our country. When I get this overall net cash flow, my next question is, what method am I using? If I'm using NPV, then I need the project specific WACC as the discount factor. If I'm using APV, then I have to get the cost of equity ungeared and then go and sort the subsidized loan, the tax savings on interest, and then what? The issue cost. Sum up all of them in order to get the APV. That is the difference. If it is payback period, how many years these cash flows will be able to recover the investment. That's it. Okay, please explain tax on royalty. Okay, the tax on royalty is that the royalty in the USA, the US subsidiaries saw the royalty as an expense. So once they saw it as an expense, it reduced their taxable profit. So rather, the company would have saved what? Tax in US. And what is double taxation agreement? Double taxation is that if you have paid tax on an income in a foreign country, and there's this agreement between your country and that particular country you did the project that you pay the tax, then you don't have to pay tax twice on that same income. So the profit that we made in US, that we paid the 50% tax on, when we came to UK, because we have already paid the 50%, it wouldn't attract any additional tax in the UK. But when you talk about the royalties, did we pay tax on the royalties in the US? We didn't, because the royalty wasn't income there. The royalty was an expense in there. Therefore, it rather saved us. So when I come to UK and I receive that royalty as an income, UK taxman is going to say, you did not pay tax on the income, which is the royalty that you got in US. So if you haven't paid tax on it in the US, then there is no double taxation effect here, because double taxation will only come in when you have already paid tax on that income. But that royalties, we didn't pay any tax on it in the US. So the money in the UK as income royalty should be subject to a full UK tax, because no tax is paid on the US. That will be given to you as a relief. There's no tax paid on it already, so you wouldn't get any relief. It should be subject to a full tax rate, okay, in the UK. So the UK rate is what we are using. This is UK rate, not the US rate, okay? So double taxation will only come in when you have got what? You've paid tax somewhere, and then when you come to your country and you are supposed to pay tax, they relieve you on the basis of the tax you have paid already. So if you haven't paid tax already, there's no relief. Okay, there's no relief for you. So now when I get a net cash flows, I need to ask what method. I didn't see subsidy, I didn't see what issue cost, therefore I was using MPV. So if I'm using MPV, then the moment I get the net cash flows, I need the discount factor, which is project specific WACC. I go to the question, how do you want me to calculate the project specific WACC? The original question wasn't this. The original question, the calculation of the exchange rate was given interest rate, they gave inflation rate, and you have to calculate the purchasing power parity approach to calculate the exchange rate. We balancing time here. And the original question too, they didn't give you the WACC straightforward. You have to do proxy beta, Angier, Regier, CAPM, and WACC it to get the project specific WACC before you can come and put there as the WACC to calculate the MPV. That's why I keep telling you, when you are learning these topics, don't learn them individually. They are all together. They are all together. So when I come here, they said Brockday believes that the appropriate beta for this investment is 1.2. So if the beta for this whole investment is 1.2, I told you whatever beta you are putting in the CAPM formula is going to give you the resulting cost of capital. We don't use CAPM to calculate only cost of equity. So when I put the overall beta of a project into the CAPM, it should give me the overall cost of capital of that project. So I calculate my WACC, and when I get the WACC, I put it there. So I'll say my cost of capital will be, in this case, because they gave us the beta, risk-free plus the weighted beta, market return minus the risk-free. And what is it? According to the question, our risk-free rate, this is where we pick them. Risk-free rate is 7%, and the market return is what? 12%. So I am going to say 7% plus the beta of 1.2, 12% minus the 7%. And what is the beta? The cost of capital. 1.2 times bracket 12 minus 7, okay, plus 7, is it giving about 13%. And when I get a 13%, you discount, and everybody should be able to do that to calculate what? The MPV. That's it. So this is all about international investment appraisal. The only problem is it is much time consuming. So you don't have to hesitate. You have to be flowing. You have to be flowing. Okay, that's it. That's it. What other factors can you take into account? Think about political risk, the cultural risk, the regulatory risk, and all that. And also think about the fact that exchange rate risk. How would we say that every year the dollar is going to appreciate by 5%? So it's 95% every year. It doesn't make realistic sense, isn't it? It might be changing. Think about inflation and the cash flows. The inflation, we say selling price, variable cost, fixed cost, all of them are subject to the same inflation rate. It doesn't happen. Okay, think about the unit, 50, 100, 100, 100. How will we predict with certainty? Think about the tax rate. It's going to be 50% throughout the 4 years. It might not necessarily be possible, isn't it? Think about the residual value and the working capital you are recouping. We will recoup the whole 4 million. Is it okay? Not necessarily so. You are standing here we will sell the asset in 4 years time. How can you be seriously confident that you're going to sell it for 20 million? You can't say that. It's all based on assumptions. So we have to consider them. If we are not very sure of those figures, then we have to think of bringing risk analysis like sensitivity analysis to know how much these values will change in order for the NPV to be equal to 0 to come out with the contingent plans. What I would advise you is, if you are home and then you do every international investment appraiser question from the revision kit, you sit down and have a look at that. The other factors they discuss, it cut across. It's almost the same thing. It's almost the same thing. Go to ACC website, pick international investment appraisals, look at the other factors, political risk, cultural risk, and the cash flow things, the cost of capital you use. They are the very things they discuss. So have a minute, look at them. When you go to the room and they ask you, just give it to the examiner. It's a stereotype thing. Okay, so that is what I will advise you to do. So that is basically the case. That is basically the case and the international investment appraisals. Okay, now there's a question in here called Polycarp PLC. This is a very old question and it's in relation to APV. The unfortunate bit is that there's an aspect called debt capacity in this question, which is not examined this time. So you can try it, but don't bother yourself with the debt capacity. I will need to let them review. We have to review this. The debt capacity. It's a very brilliant question, but don't bother yourself with the debt capacity because it's not more examined. But everything is staying constant as it is. Okay, so you can have a go through, but don't bother yourself with the debt capacity. Okay, so now I am moving you straight to valuations, acquisition, and measures. As I told you last week, the moment you finish APV, the hard work is done until hedging. Because international investment appraiser, what we've done is not any new knowledge. The only thing that you need to remember is how to generate what? The cash flows. That's it. The rest is the same as what we've done. The problems there will be estimating exchange rate, double taxation, how to get the cost of capital, how to get the cash flows in terms of sales, inflation, and all that. Tax and all that, we know them from chapter number 2. Is the same principle. That's why I was telling you, master the chapter number 2 and then you can flow it up. That's why chapter number 2 took all the time, which I was okay with it, because when you get that one as a base, it's going to help you alongside with whatever we're doing up to until we get to hedging. So valuation, acquisition, and measures. This is measures and acquisitions. Okay, I would have to say last June exam, the examiner didn't bother with measures and acquisitions. I haven't yet seen the September questions though, but December 2015 measures and acquisitions should be waiting, because every time it happens to be there. The examiner was funny last sitting and it wasn't there, so watch out. So valuation, acquisition, and measures. What do I tell students here? Okay, what do I tell students? I tell students this, that measures and acquisitions, you need to know these areas. You need to know what is called the valuation of business. First, you need to know how to value the business, because if A is going to buy B, then we need to know how much A is supposed to pay, and that will call for the valuation. B, think about, if we know that we have to pay 100, what method of payment are we going to use? They call it mode of payment. Should we use cash or should we use share exchange as you did in your P2 and F7? Should we use cash? Should we use shares? Should we use debt? Okay, think about take over regulations. Think about takeover regulations. Okay, think about takeover regulations, and then think about how to defend it. Defensive strategies. Let me put that way. Defensive strategies. Somebody will say defensive tactics. So these are the main areas. These three are in chapter number 10. which I have recorded it for you. They are just discursive things. I've discussed all of that. So please go and listen to that, so that I will use the time to do the valuation, the discursive bit, because I've recorded. That one doesn't need too much explanation, so you can read that one. So let's go to the valuation. I'm going straight with the valuation. What methods can we use to value a company? We can use the dividend valuation model or dividend growth model. We can use the discounted cash flow method. This is what is called the free cash flow method. And this is what took the time in chapter number 2, if you remember. Okay, so I normally tell students, don't come and waste your time and the free cash flow in this chapter, because what is in this chapter is just refreshing your mind. The objective of packing it in chapter number 2 is that by the time that you get here, you have practiced and played with that free cash flow methodology, because that is the main thing that is coming. Somebody told me, I think one of you told me in the mentoring session that in the September exams, he asked the question, you should distinguish between free cash flow to entity and then free cash flow to equity. Free cash flow to entity is the corporate value. So free cash flow to entity is the normal free cash flows. It should be for both equity and debt holders. And free cash flows to equity is only to equity holders. You think about this. If you are not able to explain that, I don't believe that it will be fortunate on your part. PE ratio method, we can also use the net asset and dividend method. Okay, dividend yield method. I have to say, so far as P4 is concerned, the valuation techniques is within free cash flow and then what? The PE ratio. Those are the very common ones. Net asset basis, dividend yield basis, and dividend valuation. They are very straightforward things. Okay, so let's go straight to do dividend valuation. According to the dividend valuation, the value of the company is the present value of the future what? Dividend, using cost of equity as a discount factor. And don't forget, the dividend could be constant, the dividend could be growing, or any form. Is the PV of it. So when you are using dividend valuation, ask, have I got constant dividend? Have I got dividend growing at a constant rate? It's the same as what we did in the free cash flow. I'm going to give you the same formula. And I normally say the examiner can also do it any. Okay, if it is constant, then I have got a perpetuity. A constant perpetuity, the PV is equals to that constant cash flow, which is the dividend, divided by the cost of capital. The cost of capital for dividend is all cost of equity because it's shares, multiplied by discount factor of what? The base year. So now instead of free cash flows, we are putting what? Dividend. When it's growing, we will say D0, 1 plus the growth rate divided by cost of equity minus the growth rate multiplied by discount factor of the base year. And D0, 1 plus G. This is raised the power 1. So it's like they've given you next year's dividend. So this can also be calculated as D1, cost of equity minus the G multiplied by discount factor of what? The base year. And what are we trying to explain? So if the examiner says next year's dividend is this, if next year's dividend is that, then obviously you need to know that he has already done this one for you. So he needs this formula. Okay, he can tell you dividend year 1, year 2, year 3 is so much, and dividend will grow thereafter. That is any, because according to the dividend valuation is the present value of the future dividend. So let's go to the note straightforward to pick this. Winterburn PLC, the market expects a rate of 20% per annum on ordinary shares in Winterburn PLC, a company which is expected to pay constant annual dividend of 20p per share. At what price will the market value the shares? This is straightforward. Don't even dream about it. And P4 exams. Okay, so dividend is 20p. Dividend is going to be constant. Cost of equity is 20%. And they didn't tell us that this is from year 2 or year 3 or year 4. So the assumption is that the base is year 0. Discount factor of any percentage in year 0 is 1. So there's no need for me to multiply by discount factor of the base year because it's going to be 1. So I will say 0.2, which is the 20p, divided by the 20%. And this is the market price. Next, Seaman PLC is expected to pay a dividend of 30p per share next year. What is? I don't understand your question. What is off and by? What do you mean by that? Okay, I'm going on until you come back because I don't see you said what is off and by. I can't get the link. Okay, so let's move on. Seaman PLC is expected to pay a dividend of okay. It's here. This is discount factor of the base year okay, discount factor of the base year. Refer it from chapter number 2. You will get it right there. Discount factor of the base year. Okay, so let's go to Seaman. Seaman PLC is expected to pay a dividend of 30p per share next year. The market expects dividend to grow at a rate of 5% per annum and has a required return of 20%. Okay, they said 30p per share next year. So once it's next year, this is the formula I want. Okay, and then that 30p 0.2 minus 0.5. This is that. Have a look at this one. Okay, because that one is basic. The one you are more likely to be seeing in the room is the any. So let's use RIDE. That is more challenging. RIDE PLC has just paid a dividend of 15p per share. The market is in general agreement with directors' forecast of 30% growth in earnings and dividend for the next 2 years. Thereafter, a reasonable estimate is 15% growth in year 3, followed by 6% growth to perpetuity. The market required return on investment of this risk level is 25% per annum. Estimate the market value of the share. How will I get the market value? According to the dividend valuation, is the present value of the future dividend. What are the future dividend? Question is telling me now I have paid 15p, which is year 0. I need present value of the future dividend. So year 1 onwards. And it's telling me that 15p, we are going to forecast a 30% growth in the earnings and dividend for the next 2 years. So how will I get my dividend year 1 and year 2? I have to increase the 15p by what? 30%. So when I come here, I am going to say that year 1, my dividend will be the 15p multiplied by 1.3. And how much am I going to get? Okay, I am going to get 19.5. Year 2, I will get 19.5 multiplied by 1.3, and that is 25.35. These are the dividend, which represent the cash flow. And then year 3, that 25.35. According to the question, they said thereafter a reasonable estimate is 15% growth in year 3. So I'll multiply this by 1.15, and that should give me 29.15. Then the question further said that 15% growth in year 3, followed by 6% growth to perpetuity. The moment I get a perpetuity, then what am I saying? I'm going to infinity. So when I got a perpetuity, I ask, perpetuity, are you constant or are you growing? Okay, so year 4 up to infinity, we'll go and sort that one out. What is the discount factor? The cost of the debt, according to the question, is 25%. Cost of equity is 25%. What will be the PV? 25% discount factor is not on the table. It means I have to calculate it. How do you calculate it? That is what we say 1 divided by 1 plus R. So I'll say 1 divided by 1.25. I will get 0.8 here. Divide by 1.25. I will get 0.64. Press the equal sign, 0.514. I'm going to multiply 512. I'm going to multiply by the figures. So this times 29.15 is it 14.9. I'm getting 92 there. 25.35 times 0.64, and that is 16.22. 0.8 times 19.5, and that is 15.6. Okay, now what should we do? We need the PV year 4 to infinity, just as we did in the free cash flow, the same thing, but now the cash flow is dividend. So I will pick year 3 value of 29.15 because it's going to infinity and it's a perpetuity. I ask, this perpetuity, are you constant or are you growing? That's why here I said any. He can combine all of them. So perpetuity with growth, this is the formula. D01 plus G divided by cost of equity minus G multiplied by discount factor of the base year. So I'm going to say I'm picking year 3 as my base of the 29.15, and that is what is subject to the growth to perpetuity of what? 6% divided by cost of equity of 25% minus the growth rate of 0.6. Because I haven't started from year 1, I'm starting from year 3 as the base. It means I have to rediscount it to year 0. A figure in year 3, I have to discount it using this discount factor. That's why we said discount factor of the base year. The base year is year 3. Discount factor of year 3 is 0.512. So I will go straight and say 29.15 times 1.06 equals, divide by bracket 0.25 minus 0.06 equals, all multiplied by 0.512, and that will give me 83.26. Sum them up, and this is the market value. Full stop. Don't go and do what we did in the note. We were teaching here, so we're trying to explain all of them. This is the 83 point something that we got. Why do I have to go and do all this? That's why I told you, don't come here. Stay in chapter number 2. That is where we did the present value, annuity, perpetuity, with growth and constant and all that. If you know that principle, when you come here, it's just a rollover. Okay, so that is done. Now let's go to the discounted cash flow basis. As I told you, this is the same as what? The free cash flow basis. And according to the free cash flow basis, the value of the company, which is the corporate value, is the present value of the future what? Cash flows, isn't it? Is the present value. I'm just refreshing your mind. We said the corporate value is equal to the present value of the free cash flows discounted using what? WACC. And this corporate value is made up of value of debt plus value of what? Equity. So if I want my value of equity, my value of equity is the corporate value minus value of what? Debt. We did all that in chapter number 2. Or alternatively, I can calculate the equity value as the present value of what? The free cash flows to equity discounted using cost of equity. Now we have done cost of capital. So the examiner reserved the right not to give you the WACC. The examiner reserved the right not to give you the cost of equity. All of them in a bigger question, he will ask you to sort all of them out one. Okay, so this is how the game is. Bring all of them together. Bring all the topics together. If I need WACC and it's not given, I know how to calculate WACC. So I need to push to go and calculate it. Okay, so go back to chapter number 2 as we did there. So let's take this example to illustrate. Miller Limited, the predicted free cash flows of Miller Limited, an all equity company for its planning horizon, which for simplicity is taken to be the next 5 years, are year 1 to year 5 free cash flow. The cost of capital is 12%, is assumed to represent the systematic risk of the cash flows of Miller Limited. What is the estimated market capitalization? Alternative name for market value is market capitalization of this company. Who is going to give you the free cash flow? Straightforward. And then you discount it at 12% and you say you've got the market value. It doesn't happen like that. Okay, the reason they've done this one simple here for you is that the main thing has been done in chapter number 2. That's where you have to go and learn the free cash flow. So go there and go and learn it. Nobody is giving you the free cash flow for you to discount it straight. Nobody is likely to give you the 12% cost of capital. In a good exam, the examiner is giving you the accounting information. You have to extract the free cash flow, and we learned that the free cash flow is your operating profit less tax without interest in there. So you less tax, you add your non-cash items, you less increase in working capital, you less what? Your capital expenditure to come and get the free cash flow for the respective years, as they've done here for you. Because here the note is assuming that you know how to calculate it from the chapter 2. The note is also assuming you know how to calculate the WACC from chapter 4, 5, and 6. And then everybody knows how to do the present value, full stop. So don't stay here. Go back to chapter number 2. This is just refreshing your mind. Okay, then let's take this simple question to illustrate. The following data relating to Morrison Limited is expected to continue annually for the foreseeable future. Turnover, cost of goods sold, distribution costs, capital allowances claimed, non-current asset, irredeemable bonds. Working capital changes are assumed to be insignificant because of the absence of growth. Corporation tax rate, weighted average cost of capital in nominal money terms, predicted inflation rate. Calculate the estimated equity market capitalization of this world company. Okay, they've given me WACC. So when I get the free cash flows from accounting information and I find the present value of the free cash flow at the WACC, it gives me what is called what? The corporate value. This is the corporate value. And that corporate value is made up of value of debt and value of equity. So when I get the corporate value and I knock off the value of debt, the value of equity will come up. We did a bigger one of it in the chapter number 2, and we said where it is going to infinity constant, is going to infinity with growth, with all those variations. That is where you need to learn them. Here is just refreshing your mind. Okay, so how will I get the PV of the cash flows? I will go straight and say that, okay, I will go straight and say that I have my operating profit. How will I get the operating profit? Because I need the cash flows. How will I get operating profit? Operating profit is turnover, which is sales. And the sales figure there is 525. I need to less my cost. Cost of goods sold, excluding depreciation, they said 315, and then they also said distribution cost, which is it 36 minus, and capital allowance is what we are representing as depreciation, which is 46.5. And this should give me my profit, which is my profit before interest and tax. So 525 minus 315 minus 36 minus 46.5, that is giving 127.5. When I get my operating profit or profit before interest and tax, we less what? Tax. What is the tax rate? They said 30%. So 30% of that will give me 38.25. I have to add back non-cash item here. And that non-cash items is the capital allowance of 46.5. Is there any changes in working capital? They didn't say anything. The only thing they said was that there is non-current asset purchase in the year of 72. So what is the non-current asset? That is what we refer to as what? The fixed capital. So what is the fixed capital of what? 72 minus and this should give me the free cash flow. So I will say 127.5 minus 38.25 plus 46.5 minus 72. This is 63.75. This 63.75, I need to ask myself, if this is the free cash flow now, free cash flow, are you subject to growth to infinity or are you constant? Question told us there is inflation of what? 3%. So it's subject to growth. If it is subject to growth, then I'm going to say that this free cash flow, you are subject to growth. So it's a perpetuity with growth. If it's a perpetuity with growth, the PV to infinity will be that free cash flow now into bracket 1 plus the growth rate divided by the WACC minus the growth rate multiplied by discount factor of the base year. You do the calculations. The free cash flow now is 63.75. Growth rate is the inflation of 3% divided by the WACC. The WACC is giving us 13.3% minus 0.03. Because this is now, the discount factor of year 0 is 1. And what would I get? 63.75 times 1.03 divided by 0.133 minus 0.03, and that is giving 637.5, and this is the corporate value. I use a different approach in your note because instead of me growing it, I can convert it from nominal to real, which is going to be too long. So far as the examination is concerned, this is the fastest way. So if you have understood them, you can manipulate them anyhow you want. Okay, so if this is the corporate value, I have to less what? The debt value. And then if I less the debt value, the answer I will get will be the equity what? Value. Okay, as I keep telling you, we did it better in that chapter. So have a look at that. Have a look at that. Okay, what is the debt value? If you go to the question, the debt value they said is 21 with a market price of what? 130. So my market value of the debt will be the 21 multiplied by 130. Don't forget to divide by 100. So it's 2100 nominal multiplied by 130 divided by 100, and that is 27.3. So when I less it from the corporate value of 637.5, that will give me equity value of 610.2. Okay, so this is the free cash flow method. Okay, we're going to end it here. So what I am going to ask you to do is listen. I've recorded that PE ratios and the asset basis, all of them are very basic ones. They are F9 stuff. I've recorded them. Please listen to them so that when I see you next week, then I am going to pick you. I am going to pick you from the acquisition type 1, acquisition type 2, and acquisition type 3. That is what you are more likely to see in P4 exams. So the ones like how to calculate the value of debt, if you listen, they are very straightforward. So when I see you next week, I pick you from acquisition types of acquisitions. We've done the hard work. Type of acquisition 1, 2, 3, we know all of them. So revise on your APV, because acquisition type 2 is you calculating APV. Acquisition type 1 is you using your normal WACC. Acquisition type 3 is using the WACC of combined business, which is the same as the WACC of combined activities. So revise on WACC of combined activities, revise on APV. When we come here, it's a rollover. Okay, so make sure you listen to the videos for those basic ones, and I'm using the restricted time to do the challenging areas. Okay, so our time is up, and I have to thank you very much for your time this evening. And any question, you send them to me and I will endeavor to answer them for you. So thank you very much for your time this evening. Thank you.